Hello, hello. Welcome to the Five Talents Podcast. I'm your host, Abel Pacheco. I interview the top commercial real estate investors and industry experts so you can learn from their experiences. So if you're an investor, a high W-2 earner, or real estate or tech sales professional that wants to invest in real estate without having to manage properties or leave your day job, then this podcast is for you. Or if you're already investing in real estate, but you're doing it part-time and you want to become a full-time multifamily or full-time commercial real estate investor, this podcast is for you too. You're going to learn a ton. You will learn from real-life multifamily investors and other professionals in the industry. They're going to share their blueprints for success, and I'm super excited that you're here. So I hope you enjoy the show. Hello. My name is Abel Pacheco. I'm your host for the Five Talents Podcast. We are super excited today to have just an amazing guest, somebody that's going to bring a lot of value, a lot of insight, a lot of education and knowledge around commercial real estate. So Mr. Kenny Wolfe. Kenny, how's it going, brother?
Good, Abel. How are you?
Pretty good. Hey, so I've heard you a number of times. Do you like to go by Kenny or Kenneth? Which one do you prefer?
Kenny's fine. That's what most of the people call me.
Man, so Kenny, I sincerely appreciate it. I've heard you on a number of other podcasts. I've learned some good nuggets from you along the way, and as a general kind of a newer guy coming into the multifamily space, it's amazing having individuals like yourself, giving back and giving to the community and sharing some of the knowledge and successes. So, man, we sincerely appreciate it.
Absolutely.
Yep. So for those that don't know Kenny, let me give at least just a little bit of background so you know who you're listening to and why you should be taking notes. So Kenny's really in multiple markets in across the U.S. He founded Wolfe Investments in 2012. He has $250 million worth of investments in multifamily, whether those are assets under management or investing in just in general, worth of a lot of different commercial real estate transactions in many multiple markets. So Texas, Colorado, Louisiana, Oklahoma, Ohio. He's a really solid resource. And for some of you sports fans, he graduated from Baylor, so Baylor Bear, and got his MBA from University of Texas at Arlington. So he's Texas native, and we love to have him and spend some time in Colorado too. But anyways, I'll let him introduce himself a little bit more, and then we can kind of dig in. So Kenny, tell us a little bit about yourself and what you're doing now, man. We love to just jump in here.
Yeah, sure, Abel. So so started investing in multifamily back in 2010. So it's a great time to start investing in real estate. I skipped single family altogether, jumped right into multifamily. So that's kind of my story. Went passive twice and then syndicated our third multifamily real estate investment of 76 units here in Dallas, Fort Worth. Really kind of snowballed quickly for us. So we kind of fast forward to today, we've done over 4,500 units across 5 different states. The 250 million acquisitions, that includes some of our triple net stuff as well in there, but it's been mostly multifamily on that side. And then about 3 years ago, we started buying triple net properties, Dollar Tree, Family Dollar, Dollar General, and we're buying our first advanced auto parts here in probably about 4 weeks. So that's good to add another one to the belt. And then we also started doing ground up development, and I didn't know what the heck I was doing on that. So I built 6 townhomes myself with my at risk, and then built the team. And now we're currently building 88 multifamily units ground up here in Dallas, Fort Worth. And then we just recently bought the Rockefeller building in downtown Cleveland, which we're going to redevelop into mostly multifamily.
Yeah.
So that arm growing big for us as well.
Yeah. What a tremendous, kind of background and run. And you started as a passive investor, correct?
I did twice. Yep. That's right. Yep. Absolutely.
Yep. What was it originally that got you into real estate? Like, what was it? A mindset? Was it something you learned? Was it the people you watched? Just curious on how everyone gets started.
Yeah, sure. So I started out in oil and gas. So I was on the accounting side. I've been on one rig in my life. That's all they let me on. I had a hard hat. I got a tool in my office. But that's all they let the accountants on the rig is one time. And then for the photo op. And then, but so I was in oil and gas. My dad was in oil and gas as well. So it's either feast or famine. I saw that growing up. So it's a great business when it's great, and it's really bad when it's bad. We're in the middle of a 5-year contract with Chesapeake Energy on that startup I was in. I was a CFO at 28 in that company. And so, but grew that and then to 140 people underneath us. But then realized we had to probably make a pivot out of oil and gas. Chesapeake was slow paying us on that 5-year contract in year 3. I asked a family friend, and she pointed us to one of the guru groups here in Texas. So I did their 2-day seminar. The first day, my wife and I were so excited to buy 10 single family homes. That was the plan in Dallas. Did all of ourselves. And then the second day, they talked about multifamily. And then we said, forget single family, it's too much work. And so we jumped right into multifamily.
Yeah, I've heard you say you kind of skipped right over the single family and just kind of jumped right in, right? What
Right.
was that a you and her husband and wife decision? Both of you guys were agreement, or was one person in and you had to persuade the other? How did that go?
No, so I mean, I had been reading real estate books for years. Like my library of real estate books is enormous. And so finally, we go to this 2-day event, and she gave me a good push. She said, "All right, you just got to go do it. Like I don't care what you do now." Like she was tired of me just talking about it and reading. She was okay, go do something. Anyways, we did it. I did something. So she was definitely supportive of all the way, and has been very much so. But definitely. Had that big push nice push from her to kind of get going.
Yeah, that's great. It's so beneficial, right? When you have the support. I know many investors don't, but those that do, like, man, I'm the same. My wife is super supportive and very happy, and just kind of encouraging along the way. So I know that's a good. Any insider nuggets that you've seen over the years for people that don't have the supportive system at the house?
I mean, I think they really need to, honestly, before they jump in. I mean, it's because you're dropping $50,000, $100,000 in these passive investments, and you both have to be like. I know we've talked in the past in 10 years, we've had two investors where one of the spouses wanted to come in and invest, and the other did not, and I didn't let them come in because I didn't want to get in the middle of that. That's a bad idea, I think. Yeah. So I definitely, if they're not involved or not behind you or in this, make sure that they understand it all, and take them to the 2-day events, take them networking, make sure it's a destination place if you can. That way they can get in some fun time, like go to a Chicago Cubs game and also network real estate, those kind of things. So open bribery is fine.
Get them involved, get them there, and have some fun. I like that because when you go to an event, really, we were, I guess, blessed, right? All the way up until COVID, it's trying to figure out, which event, how to go to, and really nice cities, really nice destinations. A lot of time we have a lot of fun, but your eyes get opened when you see and experience so many other people having a ton of success in real estate. So how have you been filling that gap lately? What are you doing this year?
It's been tough. I get so much energy from doing networking events, and so we co-host the MFIN conference 3 times a year. We got one in 2020 in Houston. Mm-hmm. We had 400 people show up. Yeah, so massive deal down there at the Westin. We're going to do it again for this February. We're already talking tomorrow about getting that nailed down. But anyways, so we co-host those events, and then before COVID was happening, I think I spoke at 5 different meetups across the U.S. So I was in Manhattan back-to-back nights, speaking back-to-back nights, March 7th and 8th. So I was in the middle of COVID down there. But I get a lot of energy from it. I love meeting people. I could talk real estate for hours. So, that's the way to do it. But we're seeing more and more people come out of their shell and come to some of these networking events. We just hosted some of the investors in one of our latest acquisitions up there in Cleveland, Ohio. Mm-hmm. We had 40 people fly up from across the U.S., which is cool. And then obviously we did it, safely and all that jazz. But it was good. There's definitely a demand for folks that want to see, networking, because that's such a big piece to our business. Is networking is everything.
Yeah, so important, so valuable. So yeah, it's good to hear that's, everyone's kind of coming out again, and we're excited, and I'm excited for my wife to let me do the same at some point here. So let's, maybe as opposed to starting at the beginning and talking about the end, I'd love to learn, about your latest acquisition, and maybe I'll ask you a few questions leading up to that. But what are you guys doing now? What'd you buy, or how did it go?
So far in 2020, we've bought 33 million worth of real estate. No, I'm sorry, 40 million because of the commercial stuff. I always forget about them. I shouldn't, but I do.
Yeah.
On that total there. So we bought a A class here in Dallas Fort Worth. It was a HUD loan assumption, so got that done, and then bought the Rockefeller Building in downtown Cleveland. It's a 17-story building. The Rockefellers built in 1905, so it's a historic building. We're going to redevelop that project into mostly multifamily. And then actually today we're buying a 96 unit C class in Cleveland as well.
Yeah.
So small deal, but it's a cash flow deal, and pretty much a neighbor to one of our other assets. So
Yeah.
so
Yeah, that sounds awesome. During the 2020 year, during one of the roughest, to buy something as historic as like a Rockefeller building is
right.
just super awesome, man. Congratulations.
Thanks,
That's
man.
that's amazing. So 17 stories. What is it today, and what is it going to become? You're repositioning it?
So it's always been office. They built it as an office for their folks. We're going to reposition floors 4 through 16 are going to be multifamily, A class multifamily. Two
Mhm.
and three, floors 2 and 3, we're going to keep office, and the bottom floor will be a mix of kind of retail or restaurant, whatever kind of moves in there. But the reason why we kept the office in there because right across the street from the building, Sherwin-Williams announced that right after we got under contract, they were going to build their new global headquarters right there.
Yeah.
1 million square feet. Yeah, I mean, it's
That's
perfect,
awesome, man.
perfect timing on that. And then what's cool is that on the bottom floor, we're talking to a group out of Chicago, and they may make the whole thing a food hall down on the bottom.
Would be so awesome, man.
But there's some really cool historical things in there. So there's 36 of the Rockefeller safes on the 17th floor. You
36 of what? Sorry?
Safes.
Oh, safes.
You walk
Wow.
walk into these safes. There's 36 of them up there. So who puts a safe on the 17th floor? You must be hiding something. So anyways, but there's 36 of those up there. So there's really some cool features to the building. There's marble everywhere, wrought iron. It's just a beautiful asset, and it's been office. The guy owned it for 52 years before us.
Wow.
Long-term owner, and he just kind of kept it as it is, and so we're going to really put a lot more money into it and revive it.
Wow. What a awesome project. I'm happy I caught you at this time in your career, man. So tell us a little bit about it. Was it like obviously a syndication? Was it a 506C, a B capital, or whatever you can feel comfortable talking about at this point?
Yeah, sure. So I mean, it's an office to conversion to multifamily. That's a big deal down in Cleveland downtown. The whole downtown area is an opportunity zone,
Mhm.
so it's also got that going for it.
Awesome.
What's also cool about that is that there's a Starbucks about 50 yards from our building in an opportunity zone. So it's one of the good ones in an opportunity zone. Some of
Yeah.
those, 90% of those were not in great areas, but this is a really
It's
good
a good
area.
one. Yeah.
But we've got great neighbors. Our Dan Gilbert, owner of Quicken Loans and the Cavs, just completed his multifamily conversion down there. The Waltons just bought a building close to us as well. So we got a lot of good neighbors there in Cleveland. But it's a cool deal. We did a 506B offering. We've done one C in the whole 10-year run, and I didn't like it.
Wow. That's a different for those. Sorry, can you explain that just for maybe some of the passive investors, newer kind of people listening in, the difference between a B and a C?
Yeah, sure. So a C is where you can like publicly solicit. I could go get a billboard in downtown Dallas and market a specific investment offering in XYZ apartments, right? 506B, I can't do that. I can't publicly solicit. I can use I just have to, everybody in the management, LLC or GP can raise money for that group. But they can't go get a billboard or post on Facebook, hey, I'm raising money for XYZ.
Yeah.
They have to know the people that they're raising money for.
So 10 years, pretty much all Bs except for that one time and you said, hey, this is a B all the way through. That's great.
Absolutely. Yeah, never again on a C. And also too, another big deal, the 506C, you can only take accredited investors.
Yep.
So we take both sophisticated and accredited investors on the B side.
Yeah. And so I know you've, over a 10-year run, you've had a lot of loyal investors, a lot of happy people that have probably made a lot of money, with you. And so they saw this project and they were like, I'm in, I'm in again, Rockefeller building, huh?
That's right. Yeah. I think that's definitely part of it, but also too, the opportunity zone is a big deal for anybody that have capital gains in 2020. That's a huge deal. And then it's a big appreciation play. We're buying something for about 13.3 million and going to turn into about $120 million asset.
Wow. So that's a huge forced appreciation, but probably one of the biggest ones I think I've heard, at least on my interviews. What's the business plan to create that? And maybe you can, obviously shape it. I failed to tell you, Kenny, so I'm sorry. Our audience is probably, I think we have a lot of passive investors, maybe first timers that are new to investing in commercial real estate. And then I think we also have a following of general partners or people that have done one or two deals that are trying to go figure out how to become full-time. So all of this information is really good, but how do you take a $13 million building and make it 120 valuation by forcing that appreciation up? So tell us the gameplay, man.
A lot of investment in the rehab of the asset. So it's a historical building. So it's on the National Registry of Historic Places. So what that means is that as of today, we're going to get about a $15 million grant from the U.S. government to fix this building up.
Wow.
But so the total rehab is about $84 million on this asset. Again, $15 million in grant money from the U.S. government right now. If you hold it more than 5 years, that turns into a grant. And then we've got a lot of very cheap loans and incentives from the state of Ohio and city of Cleveland as well. So there's a lot of ways to kind of get that or our basis down. But yeah, that's 13 million plus 84. And then with creating the much higher rent per square foot than what he's getting today out of office building is going to drive that value of the asset.
Wow. What an amazing project. I don't imagine it's going to be a 5-year hold. a little longer.
Yeah, a little longer. For that aspect, we got to hold it 10 years to realize the full benefit of that. So it'll be probably.
Man, what a cool project, man. Congratulations and a lot of blessing to you in that. And so that one's, sounds awesome. You mentioned some other ones, triple net lease. Your core is multifamily, right? That's kind of like your staple, type of investment for the years. Maybe tell us a little bit about that and, kind of your trajectory of how you get to do your deals now and what's on the menu basically.
Yeah, sure. So obviously that's our flashiest one. That's our redevelopment project, right? So those are the bigger appreciation plays for those folks that want that. But the risk reward ratios is kind of what we focus on too up here. So we offer 4 hard money lending, which is your kind of boring fixed 8% annual return. But some people don't like spicy. Then there's a debate even amongst here in the office. The commercial fund that we do a fund where we buy these Dollar Generals and Advanced Auto Parts kind of stores, put them under the fund. Those are mostly for steady, stable cash flow. So we distribute monthly on those, roughly about 9-10%. The guarantors on that are the publicly traded companies behind them. And then I'd say existing multifamily, that's what we've been doing the longest for sure, about 10 years now on that. And then those, we're buying one of those today. Actually, we're buying a C-class, like I mentioned, there in Cleveland. We're buying it for about $31,000 a door. Needs about $3 to $4 grand worth of rehab, but our rents will be up around $625 a month, which we'll have a 2% rent to basis ratio, which means that we're going to have a very strong cash flow deal. So investors coming into that one are more looking for a cash flow right off the bat on a multifamily asset.
Yeah, got it. That sounds awesome. So you kind of how did you become? So you went from project yourself a few years ago. You've been reading a lot of books, a lot of knowledge. You were at the kitchen table, whatever, with your wife, and your wife is telling you you just need to go do it, right? So you take your classes. What kind of big obstacles, hurdles? It sounds like a lot of them were mental, but what did you do to kind of, start the run and have the success you've done, you've had over the years, man?
Yeah, I mean, I think the biggest step for me was to do that passive investment, that first passive investment. My hand was shaking. I mean, I invested 100 grand in that first passive deal. It was we bought it for 12,000 a door. The pizza delivery guy wouldn't go into the property to deliver pizza because he'd get mugged. Like it was the ugliest one on the block. But I mean, my hand was shaking writing that big check. So that was a big piece to it, is start passively. But before I handed over that $100,000 check, I said, look, this is my investment and my education. So I want to ask a lot of questions along the way. So if you're not up for that, then I don't want to invest in your deal. So they took the check, and I asked a lot of questions and learned a whole bunch, right there on a live deal. Because you can read, you can go to the seminars, you can do the, all the web stuff, education these guys have out there now. But really what it comes down to is you don't see the curveballs that hit all these deals, and they happen. There's no, there's no smooth deal, I'd almost say. We've had a few, but there's always curveballs that are thrown at a deal. And if you're in it and asking questions as a passive, and you want to be a syndicator, there's no better way to learn. For one, I think you pay more attention when you have your money on the line. But two, it's a live deal, that you're going to see in what's happening in real time.
Got it. How many times did you invest passively before? Did you say a couple times, twice?
Two, yeah. So I actually sought out a value play and a yield play because I wanted to see how both business models worked. So yield plays obviously, was supposed to be stable. That's a whole nother story.
Yeah.
And the value play was their big fixer upper. So I wanted to see how both kind of business models played out and which one I wanted to start with.
Yeah, I've heard this a couple of times where we say, "Oh, value add is risky," is some people say, and then yield play, "Oh, it's already done for you." There's not a lot of risk in that, and it's kind of the opposite, right? One yield play, you're kind of, I don't want to say gambling, but you're hoping for appreciation, and value is like, no, you're actually increasing the value. Is that how you see it, or?
No, I mean, yield play today is kind of tough, although the interest rates are making it really interesting. So we're going after a few like really high-end A-class properties that are already fixed up. Because if I can buy it for, less, let's get an interest rate below a 3%, lock that in for 10 years, the appreciation on that asset is going to move faster than it would on a C-class. That's a yield play. But I agree. I mean, there's risk to every deal. In a yield play, it's more about operational risk and about who the deal sponsor is, because that's what happened on that yield play that I was in. I had actually, it was a hostile takeover. We actually had to kick that sponsor out, and then they plugged me in because I was the only LP that had any kind of experience on running a property. I had one syndication into my belt, and they said, "Here you go." So anyway, I had to turn that one around, and we did. We doubled the money for the investors in 4 years, so it was a good deal. But I learned a lot on what not to do by saving that deal. Yield play. Wow. And then the value play is really good because you should get a lower basis, because if you're having to fix it up, you should be paying less per door for that asset. So, but then it becomes the risk is on the rehab, like are you going to come under budget? So,
wow, the hostile takeover deal sounds a bit daunting there. You came in as a limited partner, and then you ended up saying, well, the group said, "Hey, we really need your help." Is something along those lines?
Yes, we voted him out. They voted me in, and just hit the ground running. And I'm not on his Christmas card list anymore. So
I would imagine so. But it sounds like you saved the deal, man. What were some of the maybe not specifics? Okay, perfect. You can talk about them, but just even the mindset to get through that, like what was going through your mind? You're like, I'm going to take this thing over. I started passive. I'm going to end up being active. And what were some of the commitments, sacrifices you had to make?
So on that turnaround project, like I said, I was the only LP that had syndicated any deals at all, and I was like maybe a couple months into my first syndication. But I was gifted the ball of fixing it around. So I mean, you just jump in. You make sure you hire the right management company to help you out the day to day, and you just make like he was trying to get this property. It's actually sold, I think, 3 times now since we turned it around.
Wow.
Up here, but anyways, he was trying to give it away a cruise if you signed a lease in a C-class neighborhood.
Wow.
So I was like, and you have to leave out of Houston. So I was like, one, how are they going to afford to take a week off? And then two, how are they going to afford to get down to Houston for this cruise? I mean, it was the wrong marketing thing. So it was that kind of stuff. And then he was trying to really play games with a big insurance claim as well. That was the big piece to it. So,
well, and you had success though. That sounds awesome.
Around and in 4 years, doubled the money with the investors on a yield play, right?
Yeah.
So that's a pretty good return.
Yeah. Hello. You're listening to the 5 Talents Podcast. I'm your host, Abel Pacheco. If you're enjoying this podcast, then I know you're serious about achieving financial freedom. Are you ready to create your own path through multifamily investing for yourself and your family? Then I know you're going to appreciate our Investor's Guide to Multifamily Investing. It's titled Tackling Commercial Real Estate the Easy Way. We use this guide to invest ourselves in $93 million worth of real estate. So we're going to show you the basic mechanics of multifamily syndications and how to evaluate your next passive investment opportunity. So the best part, if you subscribe to our podcast now, leave us a review and a rating. I'm going to give you a free copy of our ebook. So please take a moment to do that now. Once you've done that, go to 5tcre.com/ebook, 5tcre.com/ebook. Make sure to let us know you left a review and we're going to send you a free copy. So thank you so much for subscribing to the 5 Talents Podcast. We really appreciate it. And so, roughly speaking, I know you don't have to talk specifics, but roughly high level, how many deals have you done a year, every year? It's 10 years. I mean, you've got a strong track record.
I mean, I think we've done over 35 deals on the multifamily side over 10 years. We've sold some, we bought, obviously keep buying some as well. But so right now I think we're down to 25.
Okay. Yeah. 35 total transactions. 10 of them have gone full cycle, and then still managing, 20 and change, and you kind of keep going from there.
Right. Yeah. And then we've actually still own our first syndication deal we've ever done. So we've pulled out over 400% returns to investors on that deal. And we still own it. It's beautiful.
How did, was that always the plan? Keep it forever or hold it forever? Or no, it just worked out so well, you can give capital back and everyone says, let's stay in it.
Right, exactly. So, I mean, I always tell investors, I'm more of a long-term hold guy myself. I always tell them 5 to 7 years. Rockefeller would be 10, but just because but we try to do a capital event in the first 2 years, to get them back, the majority of their investment in the deal, 50, 60, 70% on a cash out refi or something along those lines. And then we hold it for the tax shield and the cash flow. And that really is an awesome gift to do. The tax shield alone is amazing. I don't think people talk about that enough.
Especially if somebody is a real estate professional, right. And you have that designation from the IRS, or if you're a high, paid W-2 earner and your spouse is at the house, she needs to be, or he or she, whoever's at the house, needs to be a real estate professional, get some material participation so you can write off all the losses. But those are the tax part of it is awesome.
Exactly. Yeah.
Well, so let's, I'd love to hear about this, more to the way you position the assets to put capital back in investors' hands as much as possible. What are some of the terms, the financing, maybe intricacies? You've done a ton of deals, so you probably can say, hey, you should do this and watch out for that if you're trying to put capital back in investors' hands.
Yeah, I mean, so really, you need to decide. I've got a YouTube channel, and I just got a video on this topic on loans and which one to use.
That's perfect.
It's great timing. We've used bank loans, we've used bridge loans, and we've used agency loans. I kind of threw them all in those 3 camps.
Bank, bridge, and agency.
Agency, right? Yeah.
Okay.
So you're going to do so. Bank and bridge are basically the same, except a bank is going to be better if there's not a lot of rehab, but a little bit of operations to clean up on the deal. So a little bit of hair, not a lot. But a bridge loan, we've done that a couple of times. Those are going to be those are going to have a short. They're typically 2 to 4 years on the term. So there's some pressure to pull off your business plan. But the benefit is that they'll basically, the couple of deals that we did, they almost funded the entire rehab, 100% of it. Higher leverage on the purchase price, and there's little to no prepayment penalty when you exit, right? That's the big deal there. And then the agency loan, that's what everybody thinks they want. And it's most, but you only want that on a long-term hold, because that prepayment penalty will eat your lunch, you know? So like an example is we own an asset in Columbus, Ohio. We bought it for 65 a door. Brokers are telling me it's worth 120 a door today. And so we've created massive value for the investors. But our prepayment penalty is $2.5 million right now. And we raised 3.7 to buy that asset.
Wow.
So that eats up a lot of return. So because it's a Fannie Mae loan, we're stuck probably another 3 to 4 years to own it. And stuck is shoestrung of a word because it's cash flowing. They're paying down our loan. I mean, it's not a bad thing, but
deal's great, but you just can't cash out.
paper looks very, very good. But we can't access that for another 3 to 4 years until we sell it. So
yeah. Okay. Well, those are great points. I like that. Bank, bridge, and agency. And so it sounds like you've done, non-recourse and recourse loans just over the years, right?
Right. Yeah. We try to stick to non-recourse. That makes my wife happier. But we've done a few recourse loans on big turnaround projects and small ones as well.
Okay, that's awesome. And then the triple net deals, are they? Maybe describe those a little bit. So I heard Dollar General, AutoZone. It sounds like single tenant, big, kind of anchors in their own buildings. Triple net, for those that don't know or are listening maybe for the first time hearing this, it's really, instead of having to do the rehab or maintenance or pay property taxes or insurance, that's on the owner. So they do the triple net leases. But maybe give us some insight on what those deals are like.
Yeah, sure. So, those are really more for folks that are looking for kind of steady, stable cash flow. We don't have as much control over the appreciation like we do on multifamily. So really, we're buying these because the rent shows up every single time on the first. We don't have to chase rent like we do on multifamily sometimes. And because they're double net or triple net, we don't have to fix the toilets. The tenant does. So Dollar General fixes all the day-to-day operations, keep up. They do the landscaping. So the operational risk is almost minimal. Almost zero, I'd say, minimal and almost zero on those assets. They reimburse for the property taxes and the insurance. So there's a lot of de-risking the commercial aspect, and it's all about who guarantees the lease. So we only focus on publicly traded companies that guarantee the lease. So we don't do a strip mall with Linnell's and all that kind of stuff, because I don't know if I can trust their financials. But if someone lies on the Dollar General financials, they're going to jail. So we can trust those financials as well. So we have great guarantors. There's minimal stuff that we have to do to keep it up. So it's really simple math on the monthly return. Is the rent comes in on the first, mortgage is out on the 7th or 8th, and then we pay out to investors on the 25th. It's very simple, not a lot of brain damage.
Yeah. And so you buy the properties. Does Dollar General already own the buildings and they're selling it, or you start with the building and then fill it with the right tenant, or how does that work in your deals?
So what we've done is we focused on buildings that already had tenants in them, and those tenants do not own the building. It's their business model not to own the real estate they're in, those companies that we just mentioned and more. But so we're buying an existing lease. They're already in there. It's already in there. Day one. Pretty simple.
Makes perfect sense. Yeah. And the difference between, I heard double net and triple net. Double net, what, you still have to do like the roof or the something under there? What's the difference?
Right. Yeah. So the double net, our double net, and each lease is different. So you got to make sure you read it. Yeah. Typically, our worst case double net, what we're responsible for is the roof, the structure of the building, the parking lot, and the HVAC. Those 4 things. The rest, the tenant takes care of.
Got it. Yeah, this is a really cool kind of business model where we're by the time this is out, God willing, we should have we're buying a commercial portfolio and it's
Nice.
a triple net like a net sale lease back. So the business that's in it owns it, and then we're buying it. They're getting cashed out, but we have a 20-year lease. And what I love about these types of deals, Kenny, is kind of like what you're saying is I know the rent's coming in on the first because of my credit structure. The company is like, they're going to pay the rent. They need to. And then there's the pro formas are a little bit different. It's
Yeah,
like
yeah,
all income and the expenses are like, whew,
yeah.
they're off. And then and when you're doing your pro formas or you're looking at it, it's a little different than an assumption because you've already got your stair step approach to rental increase or whatever for the next however many years. And
Right.
it's a different model. So I like that a lot, man. Well, congratulations. You've had a ton of success over your years, and just really appreciate you taking the time to share. And I do have one or two more questions, but before we go, is there what's the best place for our listeners, our audience, to get a hold of you? And if they want to get closer to your world, it sounds like you put out some education content and opportunities to invest. How do we get a hold of you?
Right. So yes, we do. Yeah, you just mentioned it. We've got a YouTube channel. We put out a video every Thursday. So we've got those out there now. And make sure you subscribe if you're not on there. And then the best way to really contact us is through our website, wolf with an e dash investments.com, and that'll kind of direct you to all the things we're doing up here at Wolfe Investments.
Oh, that's great. Yeah, we'll make sure to reach out, and you can learn a lot by reading some books. You can learn a lot by going to some conferences.
Right.
I heard Kenny say, he learned the most in that beginning when he was investing passively. I did the same. You see the numbers. So there's a lot of wisdom in there. So if eventually at some point you want to be doing a deal where you're getting $15 million plus from agencies and government organizations, the city, to go buy a Rockefeller building, it's a great place to start. I would encourage you highly to check it out. And there's just this is an awesome track record, man. And kudos to you. So is there anything else we haven't talked about? Anything I didn't ask you about that you were hoping, man, I do want to talk about these subjects or topics, anything else, and take as much time as you want.
No, sure. I mean, we just push a lot of, I care about our investors a lot. So I always want to make sure that they're in the right deal for them. So we'll have, I've got this one investor. She always asks me, how much should I put in this deal? I'm like, I can't tell you that, you've got to choose this for yourself. And so I think I take the approach, it's better to spread out your real estate investments over multiple different types of real estate. And actually in other investment classes too, as well. But I mean, that's why we do what we do. Is we have four different asset classes that we invest in real estate that have different risk and reward ratios. So if you want more cash flow, then you probably don't want to do a development deal. If you need cash flow today and right off the bat and stable, the appreciation ground up development stuff that we do is probably not for you. But if you're younger or just want to really grow your net worth, then the appreciation stuff, the multifamily and development stuff, is more up your alley. So it's kind of, you got to really make sure you sit down and know what you want out of your retirement and when you're retiring. Is it early, or is it now, or is it a couple of years down the road? Do you need cash flow today? Do you not need cash flow today? So it's really kind of when investors ask me how much should I put in a deal, or what deal should I go into, I can't decide that for you. You've got to, you and your spouse need to be on the same page as to, when you're retiring, what that looks like. Do you want that second home paid by some other investment, which if you're going to do that, you should have your investments pay for your toys. It's really kind of getting to know, so you and your spouse have to kind of choose your own adventure on your investing.
Yeah, that's awesome, man. Thank you so much. That's was a really good insight. And on that point for you, what is this, afforded you and afforded you your lifestyle, you and your family, man, just give us a little bit of motivation on what a 10-year journey could equate to.
Yeah, I mean, so we started out with 250K into passively and multifamily. And our first syndication deal, 250K, and then poured basically everything back into the business. But today we're about, net worth over 15 million over in 10 years, and I'm only 39, so hoping to break the 20 mark by 40. That's the goal.
That's awesome, man. Well, that's just an amazing run, and congratulations. And you've had a lot of success. You deserve it, brother. And you've been helping a bunch of people along the way, and helping them with their dreams and desires and hopes and goals as well. So that's great. Mm-hmm. Well, I sincerely appreciate all the time and just giving back. And so my name is Abel Pacheco. Again, I'm your host for the 5 Talents podcast. We've been listening to Kenny Wolfe right now, just an amazing nugget. So I would say hit rewind, get a notepad and a pen. If you're not taking notes, it's a good one to do so. And if you heard something you appreciated today, leave us a 5-star review. Go to Apple Podcast and do so. And then a written review is amazing. Anything we can do to improve, I would appreciate it. And Kenny, if somebody reaches out to you from the show and mentions, hey, I heard you on the 5 Talents podcast, make sure to just give me a little heads up so I know that we brought some extra exposure to you, man. That'd be awesome.
Absolutely. Well, yeah, I appreciate it.
Well, good deal. Thanks, Kenny. Thanks for everything you do, man.
Yeah, thank you, Abel. Appreciate it. Thank you.
All right, bye-bye. Thank you for listening to this episode of the 5 Talents podcast with your host, myself, Abel Pacheco. Each week, we're going to bring you interviews from industry experts and commercial real estate investors who follow their dreams and achieve massive success. Before you leave, let me ask you a few questions. Did you enjoy this episode? Did you learn something valuable? Was your mind stretched to what's possible and what you can achieve? Do you want other experts just like the one you heard today? If you answered yes to any or all of those questions, then please take a moment to subscribe to the 5 Talents podcast, give us a 5-star rating, and most importantly, leave us a written review. Tell us what you liked, tell us your favorite guest, give us any feedback. I'm excited to learn and improve so you can get a more valuable show. So thank you again for subscribing to the 5 Talents podcast.